Hey everyone, Longacres Finance here, and today I will be taking a look at 5 monthly dividend paying stocks. That's right, these 5 stocks all pay investors a generous monthly dividend income stream that is quite safe and reliable. Monthly dividend stocks are ideal for individuals who seek to create a steady, reliable, and consistent passive income stream. I'll be reviewing 5 stocks that I personally like, starting with the smallest current dividend yield and working our way to the highest current dividend yield. I'll also try to explain how each of these companies works, dig into their financials, and make some valuation assumptions. Are you ready? Then let's go. Number 1 on our list is STAG Industrial, ticker symbol STAG. STAG currently offers a 4.51% dividend yield, and they recently bumped their monthly dividend up to 12 cents and change per share, up from the previous flat 12 cents per share. That increase may not seem like much, but keep in mind this is a monthly dividend stream, and investors receive the additional amount 12 times per year. STAG pays its dividend mid-month, usually on the 15th or the first market day after, if the 15th happens to fall on a weekend or a holiday. STAG is a REIT, or a real estate investment trust, which is basically a company that owns, operates, or finances income-producing real estate. More specifically, STAG is an industrial REIT, as their name suggests, and its main line of business is single-tenant industrial properties. STAG's top client is Amazon. That's right, the same Amazon that's been conquering the world and destroying competitors left and right. I don't know about you, but to me, the opportunity to become Amazon's landlord sounds quite appealing. But that isn't the only reason to like the stock. Amazon only accounts for 3.8% of STAG's properties. You can see their top 10 clients here, and there are some more popular names on this list, such as Costco. STAG has an excellent management team that has expanded its portfolio to 550% growth in square footage and almost quadrupled the number of properties they own since its IPO in 2011. Growth is always nice, but the impressive feat here is management has achieved this growth while lowering its net debt to adjusted EBITDA by 25% at the same time. Revenue growth for STAG looks nice, averaging about 30% per year during the past decade. That growth has been slowing down, with the last few years in the mid to high teens, which is still a very good growth rate. Operating income has grown nicely as well, usually above 30% per year. Dividend growth has slowed down during the last few years, but STAG already pays a pretty generous yield, and we shouldn't expect this stream to grow quickly anymore. Since STAG is a REIT, we shouldn't really look at its net income, because it's an inferior measure of performance for REITs. This is predominantly due to depreciation. Most businesses have depreciation affecting their net income, but real estate is a different type of business, and property typically does not lose value, but rather appreciates over time. The metric you want to use for judging the performance of REITs is FFO, or Funds from Operations. All REITs report FFO, and this figure excludes depreciation, therefore providing investors with a more reliable picture of the company's bottom line. The one weakness of FFO is that it does not deduct capital expenditures required to maintain existing properties. Thankfully, we have the AFFO, or Adjusted Funds from Operations, which adjust FFO for capital expenditures. The two areas where we can evaluate a REIT are by the growth of FFO, or AFFO, and by the use of multiples. For most stocks, investors use the PE ratio, or price to earnings, but for REITs, it is more common to use the price to FFO ratio, or price to AFFO ratio. The one change here is you don't actually use the stock price for this ratio, but rather the market capitalization of the company. Let's take a look at STAG's FFO, AFFO, their growth, and multiples. FFO has been growing nicely for STAG, at a long-term average of almost 43%, and more recently at about 20% per year. AFFO, in this instance, looks like the same exact number, so no adjustments for STAG. STAG's price to FFO ratio is currently slightly above its trailing ratio of 16.65. I self-computed these with estimated market cap figures, so take these as an estimate in case you find slightly different multiples online. But this tells me that based on its long-term multiple average, STAG is currently fairly priced and is a reasonable buy. If you're enjoying the video, make sure to push the like button and subscribe to the channel so you don't miss future videos. Number 2 on our list is Realty Income, ticker symbol O. Realty Income currently has a dividend yield of 4.61%, paying a monthly dividend of 23 cents and some change. This dividend stream has been growing since 1994 when the stock went public, making Realty Income one of the longest dividend growth REITs on the market. Realty Income, similar to STAG, pays around the middle of the month. Taking a look at Realty Income's most recent investor presentation, we can see they own 6,592 commercial real estate properties, with an average of 9 years of remaining lease terms. Their portfolio ranges over 600 clients spanning 51 industries, and with 51% of rent coming from investment-grade rated clients. They also have this interesting slide showing the impact COVID has had on their operations. As you can see, almost 94% of rent was collected in Q4, which sounds pretty good to me. The most troubled clients have been theaters, which should be reopening in the near future and can start paying their rent once more. The impact on health and fitness properties is minimal, with 7% of properties closed. And overall, about 5% of properties of the entire portfolio are closed. Realty Income has a strong track record of positive annual earnings growth, with 24 out of the last 25 years experiencing positive growth. The stock has rewarded long-term investors with above-average returns since inception. They have a 15.3 compounded annual return that outpaced the Nasdaq, Dow, S&P 500, as well as the broad REIT index. Taking a look at their top clients, we can see some popular names like Walgreens, which is their largest client. 7-Eleven is the second largest. Dollar General is number 3. We also have FedEx, Walmart, CVS, and Home Depot. Some very solid companies here. Of course, you can also see Regal and AMC, the 2 movie theaters that aren't doing so hot now. We can also see Realty Income is predominantly a retail REIT, with 84.4% of their properties being retail properties. 10.9% of their property is industrial properties. 3.1% are office space, and 1.6% are agricultural. Realty has a solid track record of dividend payments and dividend growth. They have made a total of 109 dividend increases since 1994, with 93 consecutive quarterly increases, averaging a 4.4 compounded annualized dividend growth rate. Taking a look at annual revenues, we can see year-on-year growth during the last decade, averaging around 17.5% per year. The average growth is slightly overstated due to a big jump in 2013. Nevertheless, excluding 2013, the average revenue growth is still a solid 12% per year. Operating income has also grown nicely, with dividend growth trucking along between 3 to 5% per year. Their FFO has grown at a rate of almost 20% per year. This is a key metric, and this shows investors how much funds are earned from operations, which also means how much funds are available for distribution. AFFO looks very similar to FFO, also with an almost 20% annual growth rate. Using estimated historical market cap figures, we can compute the long-term price to FFO multiple is just south of 20, and currently Realty trades around an 18 multiple. This implies the stock is probably fairly valued and potentially slightly undervalued right now. I can tell you from looking at their price history, Realty very rarely trades below fair value, and if you're a long-term buy and hold investor, there may not be too many opportunities to buy the stock at a discount. Number 3 is LTC Properties, ticker symbol LTC. Yup, another REIT, but unlike Stag and Realty Income, LTC focuses on senior housing and healthcare properties. The stock currently offers a nice dividend yield of 5.41% and pays a monthly dividend of 19 cents per share. The dividend payment is typically paid around month end, usually on the last business day of the month. LTC used to be a quarterly dividend paying stock, but switched to a monthly dividend stream back in 2005. So they have a pretty long track record of monthly dividend payments. LTC currently has 181 properties. 73 are skilled nursing, 107 are assisted living, and they also own some parcels of land and 1 behavioral health care hospital. These properties are split amongst 29 unique operators, with the largest being Prestige Healthcare, Brookdale Senior Living, and Senior Lifestyle Corporation. LTC collected 98% of their contractual rent and mortgage obligations last quarter. Revenue growth for LTC has been okay up until 2020. Senior living homes were greatly affected by the pandemic, and this has rippled through the industry. LTC was unfortunately negatively impacted by the pandemic, more so than the prior 2 REITs we looked at. Their operating income paints a similar picture as revenue history. The dividend stream has plateaued since 2017 at the current $2.28 per year, but it remains stable and safe for the time being. FFO growth took a dip in 2020 that mirrors the decline in operating income, however remains positive on a long-term basis at 6% growth per year. LTC has historically traded around 15.5 price to FFO, and currently trades for a slight discount at 14.27 price to FFO. Personally, I think the dip in 2020 was a one-off event that won't have a long-lasting impact on LTC's future. With a significant portion of seniors vaccinated now, the future impact on the senior living industry should be minimal compared to the recent past. I also think there will be higher demand for senior living and skilled nursing homes in the future as the US population ages. LTC has a bright management team that is poised to position the business to capitalize on the growth in this industry. Number 4 is Main Street Capital, ticker symbol MAIN. MAIN currently offers a juicy dividend yield of 6.7%. The current monthly dividend amount is 20.5 cents that is typically topped off twice per year with a special dividend amount. The stop-off was not exercised in 2020, but should come back in the near future. Main is not a REIT like the three prior stocks we looked at. They are a BDC, or a business development company. A business development company is a company that offers financing to small and medium-sized companies to help them grow during their initial development. Essentially, they provide financing to companies that have outgrown their relationship with small banks, but aren't large enough to partner with a major bank. They act essentially like a bank, however they have lower operating expenses and better margins, which means they stand to benefit more than a regular bank from their loans. Main went public in 2007 and currently has about $4.3 billion in capital under management. They primarily invest in the underserved lower middle market, which are companies with revenues between 10 and 150 million. Main has a long streak of never decreasing its dividend stream and has increased their monthly distribution by 86% since inception. They are one of the most popular BDCs on the market right now, with a solid management team. Main stands out from other BDCs in that it is internally managed, resulting in lower operating costs as compared to externally managed BDCs. You can either take my word that Main is one of the best BDCs to own, or we can take a look at a few metrics to see why. There are a few key metrics investors should pay attention to when reviewing potential BDCs. The first is the weighted average portfolio yield. Main currently has a portfolio yield of 8.7% that is sufficiently higher than its dividend yield. You will find BDCs with higher portfolio yields, however the highest yield isn't necessarily the best. Keep in mind the higher this yield is, the more risky the underlying loans are. You basically want to shoot for a portfolio yield above the dividend yield, but on the lower end of BDC's average, that have historically trended above 10%. Another useful metric to evaluate a BDC is its NAV price per share. You want to look for a growing NAV price per share. This shows us that a BDC has a solid management team that is growing the business over time. You also want to look for BDCs that on average trade above their NAV per share price. The highest quality BDCs are valued by the market for a premium. I know this may sound counterintuitive, but it is a more conservative approach to investing in BDCs. Another useful metric is the non-accrual loan ratio. This essentially shows you how many loans in the portfolio are in default. As of Q4 2020, Main had 1.3% of its investment portfolio as non-accrual investments. This is actually quite reasonable. And the last metric we will look at is the net investment income. This is the income that is used for distributions to investors, and will give us an idea of how safe the dividend stream is. Net investment income took a small dip in 2020 after 4 years of decent growth. This brought net investment income below dividend payments, which can be okay for a short period of time, but the company cannot sustain this over an extended period of time. I think Main will be just fine going forward. They have one of the best management teams, and hands down are the best BDC to own. The stock may trade for a slight premium right now, but it seldom dips below fair valuation. And number 5 on our list is Dynex Capital, ticker symbol DX. Dynex currently pays a whopping 8.6% dividend yield, with a monthly dividend of 13 cents per share. Dynex is an internally managed mortgage real estate investment trust, another REIT, similar to the first 3 companies we looked at. The difference between Dynex and the prior 3 REITs is that Dynex doesn't rent out properties, but instead focuses solely on mortgages. They focus on low-risk agency mortgage-backed securities and use leverage to amplify the small MBS yields into very attractive ones. This is a somewhat safe form of creating a nice dividend yield. However, it carries interest rate risk and makes this REIT very sensitive to changes in the interest curve. Dynex has an excellent management team that has managed to position its portfolio to take advantage of shifting market trends. They are a relatively small player in the MREIT environment, allowing them to reposition quicker. Dynex also offers preferred shares of its stock. The main benefit is that preferred shareholders are privy to receive dividends first should the company run into cash problems. The common stock shares are priced right around book value, which implies they may be fairly valued at the moment. In the chart here, you can see how quickly Dynex was able to shift their portfolio during the past year from agency CMBS to RMBS. This resulted in a return of 15.2% to investors during 2020, thanks to the excellent management team. Dynex is probably the riskiest stock on this list, but offers the most generous current dividend yield. I think they will continue to execute in the long term, but do carry more risk since interest rates will go up in the future. There you have it, 5 really good monthly dividend paying stocks. Let me know in the comments below if you like any other monthly dividend stocks. Thanks for watching, see you next time.